Welcome to this short presentation of the balance sheet. The balance sheet is a vital part of the company's yearly report or the company's financial report. The main part of the financial report is of course the profit and loss statement, which is covering a period of time, showing the result of that time, and then the balance sheet, which is a statement showing the value and how the values in the company are financed on a certain point of time. You can see that down here we are talking about a balance as per the 31st of December 2017. So what's in it? What does it show? Well, there are two things, the assets and the liabilities. Assets, as you see, is the value of all the assets in the company. And we can go down and look at the example down here. Balance sheet from the end of December. We have assets and liabilities. And there is a very strict rule about those two. They are always equal to each other. So total assets equals total liabilities. Looking at the values in the company, it could be many things. We divide them into two groups, fixed assets and current assets. Fixed assets, as we write up here, that's assets meant to be in the company for a longer period of time. That's the foundation of the company. So those assets, those values will not go out of the company. It could be buildings, the offices where the company has its place. It could be machinery, cars, and so on. And of course, at some point of time, they will be sold. For instance, a car, they won't have that forever. But, you know, it is not something which we are going to sell or to convert into money. It's at the foundation of the activities. We use actually the cars, we use the buildings, we use the machinery in our normal activity to create value for the customers. So the opposite, the current assets, that's assets which are meant to be sold or changed into cash, or perhaps already is cash. And we can see the current assets here, cash and cash equivalents, 100 or 100,000 if those figures here were in thousand. Securities, trade receivables, inventories. So inventories, you know, is stock which is for sale. So we want to get them sold and convert them into cash. Trade receivables, well, that is when we have sold to customers who has a credit line at our company, in our company. So they haven't paid yet, but of course they will pay when due time is coming. And the securities will also, perhaps when the price is right, be sold with a small profit. So all current assets is something that we will sell or change into cash, or already is cash. Cash is a current assets. And fixed assets is assets meant to be in the company. And we can say, what is the value, the book value of the company here? Well, all the values in the company is 1,880. Now, if we look at on the other side, the liabilities, that is telling us how the company has financed all these assets. Okay? And we can see that it's financed by equity, provisions, who is let's say a sort of debt which is not actual at the moment, but we expect it to be a debt to be paid. And then the borrowed capital or the debt here, which we divide into long-term debt and short-term debt. So equity and debt, including the provisions, is how we have financed all the values in the company at this certain point of time, exactly on the 31st of December. So when we have finished the profit and loss statement, then when we start in a new year, of course, we will, I think I also told that in the profit and loss statement video, then we'll have to start from scratch. However, the cash we have in bank on the 31st, probably if nothing happened, we will also have that cash at the 1st of January. So all these figures here, they continue to let's say, live and develop over time. So if when we come into next year, buy new stock for our inventory, then our inventory will increase. So it will be 400 plus what we purchase. So we will keep on developing on the figures in the balance sheet. Whereas, as I said, the profit and loss statement, well, those accounts will have to be closed down and will start as in a new period and creating new values there. So there is a difference between the type of accounts there. Okay, fixed assets we divide also into intangible, tangible, and financial assets. And tangible, well, I think I've written something below, yeah. Tangible is building machineries. That's something you can touch. Intangible, however, is something which is more fluffy. It's goodwill, patent, know-how, and you can say, how can you establish the value of these things? Well, it's quite easy, because when we talk about our financial report, we are very conservative. So we are not guessing, we are talking about booked value. So if a building or a machinery or a car goes into our fixed assets, it will be registered with booked value what we pay for it. So we'll get an invoice, of course, when we buy the car, and it will say, well, you bought this car at this price, and this is the value that goes in the tangible fixed assets. And that's the same thing with intangible fixed assets. So it's not so that you can, create your own patent and know-how and then say, well, I think it's worth 1 or 2 million. That's a bit difficult. You cannot so easily do that in your bookings. But if you buy a recipe, let's say on a cake, and you have a restaurant, and this recipe is really a high value because no one else knows it, and everybody wants this type of cake, and you can say having this recipe, this know-how, is actually a value for you, and you can earn profit on it in the year comings. Okay, and you have bought it, and you have the invoice, and say, I have bought this recipe, this know-how, then of course it will be booked here under the intangible fixed assets. Okay, so this is value in the company, book value. So what is the company actually worth? Well, some people say, well, the book value is, all the assets less the total debt, including the provisions. The rest is equity. So that is the owner's, let's say, netto share of the value in the company. Similar if you owe a house, you have bought a house for 2 million, and you have a loan in it, a mortgage loan in it for 1 million, well, then your equity there is what you have paid yourself, 1 million. So that's the value. But of course, here we are talking about book value, and the market value could be different. But that's another story we'll have to discuss at another time. Just to come back to equity. So the formula actually for equity, to calculate equity, is to take all the assets and deduct all the debt and provisions. Okay, the rest is equity. The same thing with the house as talked about before, 2 million minus the debt, that's the equity. The equity we divide here in three different posts or amounts. The share capital, well, from the starting point of view, the owners of the company have put in capital for the company to work with. That's the share capital. Retained earnings, that is the profit that the company have established or generated over the years, and the part of the profit it has generated, which have been retained in the company, because every year, of course, the company can pay some dividend to the owners, and that's also the case here this year, that the company suggests that later in next year, in 2018, we have proposed to pay out dividend of 40 to our owners. But until it's paid, it will stay here as equity. Okay, so equity, we calculate total assets minus debt and provisions, and we can also find it from paid capital, retained earnings, proposed dividend. Okay. The last thing I will talk about is the debt, and the debt we divide into long term and short term. And what is long, what is short? Easy to say. It's 1 year. If it's above 1 year, then it's long term, and if it's to be paid within a year, it's short term. Normally, we can say short term, is our suppliers. Probably they would want their money within a year. VAT also within a year. Tax also within a year, and a lot of other things. So normally, long-term debt is mortgage loan and standing loan, long-term standing loans. So this is the structure on how the company is financing its assets. So the balance sheet is showing us all the values in the company, and how the values are financed, and the split between equity and debt. So we can also find the book value of equity and the debt and all the assets. So that's the balance sheet. Hope you enjoyed it. Looking forward to tell you the next video.